So when we look at the central bank, how would you say they differ? What are the key differences between them and say like a high street bank that I would use?
So they're one layer down. So basically, they're at the heart of the system, whereas major banks are the layer up. So you have an account with a bank. They provide services for you, and they have assets that back up those deposits. And some of those assets are stored at the central bank, which are liability for the central bank, which are then backed up by things like government bonds or other assets on the central bank balance sheet. So that's the main difference, is that, rather than a free banking system where every bank, has its own underlying assets like gold, for example, and has claims to them. Instead, most systems around the world are now central banking, which is that they're all connected to the central bank ledger. So that's the one difference, is just the layer. And then the second difference is really about what happens if they go insolvent, right? So for example, if a normal bank goes insolvent, I mean, assuming it doesn't get a bailout, then it's at risk of, basically some sort of liquidation, forced buyout, some sort of thing like that. They have to be basically reconstructed. Whereas a central bank technically can survive with negative equity. And so they don't really have risk of bankruptcy in the same way that a normal bank does. They have different laws that govern their accounting, and they have just overall different constraints. So that's kind of the main difference there.
Can there be a run on a central bank in the same way there is a run on commercial banks, or can a run on a commercial bank lead, like if it was a nationwide economic situation where people were trying to withdraw their money, say like it happened in 2008, can that lead to a run on a central bank?
The short answer is not really. So a bank run can happen in a couple of different ways. The reason a normal bank run can happen is, you don't trust that bank. You're worried they're going to go bankrupt. They're not going to pay you back. So you pull your money out, and you have two choices to do with that money. You can either hold it in cash, or you can shift it to another bank. Let's say you're worried about Bank X, but you think Bank Y is safe, and so you pull it out to Bank Y. A central bank's a little bit different. In one, there's no alternative, at least within that country's currency system, right? So there's no competitor central bank that they're going to rush to. Now, if you look at international situations, that's different. But for example, there's no world where Bank of America, for example, wants to pull out of the Federal Reserve, because what are they going to do with it, right? There's no other thing to put it in. Number two is the central bank controls how much physical currency that there even is. And so they have two sides of their monetary base, which is bank reserves and physical currency. And, you can get a situation, I mean, if enough people want to do bank runs, or if you have something like that, there's only so much physical currency out there that they can even pull into. And so if enough people try to do bank runs, you'd actually get told no, even if the bank wasn't bankrupt. Like even if it wasn't insolvent, they would just say there's literally a cash shortage, and we can't meet that demand for your claims being pulled out. And the central bank is what determines, every year, for example, the Federal Reserve tells the Bureau of Engraving and Printing how much physical currency they want to order, to determine basically what percentage of their monetary base they want to be in that physical form. So they, by basically controlling the parameters of what you can even withdraw from, they can avoid any sort of bank run scenario. Now they have other risks or downsides from having negative equity, and there's other risks that they can run into, but a bank run isn't really one of them.
Oh, interesting. Okay, so another thing, can you just I think I must have asked you this like 5 times in the past, and every time I have to get you to come back to it, but can you explain what the reverse repo market is again? Stop laughing at me, Danny.
Sure. A reverse repo is basically if financial institutions or pools of capital have all this extra cash, all this extra liquidity. For example, actually going back to your prior question, or your prior point, a lot of people don't know that if you have too much money in a bank account, it's exposed. It's above the FDIC insured limit, right? So if you have $1 million, where do you stick it, right? You can either stick it in multiple different bank accounts, or you can stick it into something that is perceived as safer. One option, for example, is treasury bills, right? Because your liability is the U.S. federal government rather than a specific banking institution. So you can put $1 billion into treasury bills if you want to. Another option is that you can put them into something like money markets. and they hold a bunch of short-term commercial paper, as well as things like T-bills. And one of the things that they do, if they have all this extra cash, and if the central bank is offering reverse repos, they can take that cash and give it to the Fed, and then they get T-bills in return, right? So they're basically lending money to the Fed and then getting T-bills, and that's basically it's a way to push liquidity away and get collateral. Because especially at an institutional level, you can do things with T-bills. You can lend them out. You can use them as collateral. And one way to think about reverse repos is, they're the opposite of normal repos, which is essentially that if you're an institution that has T-bills, and for whatever reason you need cash, you need something even more liquid, you can deposit the T-bill with the Fed, get a short-term loan that's collateralized by that T-bill. That's a normal repo, and reverse repos are just the opposite of that. You're giving them excess cash and you're getting T-bills.
This whole thing must be an accounting nightmare. Things must go wrong.
Well, I mean, for example, in 2019, you had the repo spike. That's why the Federal Reserve had to get so active in the repo markets. That's why whenever you have a big crisis, you have a big alphabet soup of programs that arise. So in 2008, for example, there's all sorts of, the central bank had to do a dozen different programs. So they basically add liquidity to the system. They want to make T-bills relatively fungible with cash, for example, to avoid liquidity shocks. And the same thing happened in 2020 when global trade dried up. Everybody still has all these dollar-based debts. Everyone says, okay, we're going to sell T-bills and get dollars to pay our debts. That crashes the treasury market. So then the Fed has to say, no, stop doing that. You can use your T-bills to get loans. We'll buy some T-bills from you with new cash. We'll give you loans based on other collateral. There's other sorts of all sorts of programs that they do because, like you said, this is at the end of the day kind of an accounting nightmare, and it's basically you're administering a gigantic ledger that's always kind of increasing in size and complexity.
Okay, now I think we need to work towards why they're going to go broke or why they are broke, and what that means. So, in your article, you talked about in 2021, the Federal Reserve earned $100 billion in interest income. We talked about that. So, I mean, my first question on that is, why do they target making a profit, and what do they do with that interest that they earn?
So they're not supposed to really do their actions based on making a profit, and they're not incentivized to because they have to give all their excess profit to the Treasury.
Okay.
Right. So basically the reason that they make a profit is for independence. Like I said before, if they were just an arm of the government, then they would be reliant on funding by the government, and they could be told to do all sorts of stuff right before an election, for example. But instead, by operating almost like an independent agency, and there are central banks around the world that are publicly traded. It doesn't really mean that much, but they still technically are. They're publicly traded. The Federal Reserve's not, but some are. So you have this degree of independence because they're not on paper insolvent. They have liabilities, they have assets, they generate their own income, they cover their own expenses. And then to avoid them operating in such a way that they're a profit, they have a monopoly, so you want to control their activities to some degree, and so they have to pay their excess profits above their baseline expenses to the government, and so that's historically how the Fed has operated. The Fed's kind of different than other central banks in that it's a public-private partnership, and so it's a little bit more complex. But at the end of the day, it's just kind of this semi-autonomous entity, but that is nonetheless overseen by the government. And so they, going back to the assets and liabilities, their main assets are treasuries and mortgage-backed securities. And their main liabilities are bank reserves and physical banknotes. And so for most of Fed history, their assets paid a higher interest rate than their liabilities. And so after covering their expenses, they earn tons of money, $100 billion, and then they give all that to the Treasury. And so in some sense, you can think of that as, the Treasury has to pay interest to the Fed because the Fed holds a lot of Treasury securities, but then all that money just goes right back to the Treasury. Basically, that almost like that portion of the debt is like zeroed out because any interest they pay on is essentially going right back to the Treasury.
Can I just ask a question? So what's the distinction that makes them independent if they have to give all their profit back to the government?
What makes them independent is that they are self-financing, and so they're required to give excess money to the government, right? They're not. It's not like every year Congress has to authorize money to go to the Fed to pay salaries, for example. Like let's say NASA, is the U.S. Space Agency. Their operations, their employees are paid by authorizations of Congress. And if for whatever reason Congress just says you don't get money this year, well, they're out of luck. I mean, they just would have to not operate. They'd have to shut down. Whereas a central bank, because they're a self-generating industry, entity, they're not reliant on these specific funding authorizations from Congress, and instead they're left to kind of make their own money, but then they have to give excess money to the government. So it's kind of this attempt at decentralization. Now, it obviously runs into limits during war, for example, or major crises. Central bank independence kind of goes out the window to varying degrees, but during most of the time, that is basically an attempt by the institutions that are constructed in order to make it more decentralized than it would be if the central bank was just a direct arm from the government.
Right. And so are there other private shareholders of the Federal Reserve, or is it just the government?
There are. Basically, it's owned by the commercial banking system.
Okay.
And so commercial banks own shares in the Federal Reserve, and they do get a small dividend from that, and they get to pick the board seats of their the Federal Reserve split into 12 regional Federal Reserve banks, and so they get to pick the majority of the board seats of their local Federal Reserve bank, and then the FOMC, which is the Federal Open Market Committee. That's the entity that determines what interest rates are going to be, what's going to happen with QE, that kind of thing. That's made up from a combination of federally appointed officials, right? So they're appointed by the president and confirmed by the Senate, as well as a subset of the heads of those 12 Federal Reserve banks. And so it's basically this public-private hybrid that is, for the most part, controlled by the federal government, but basically the ownership is officially by the commercial banks. And like I said before, there are some Swiss's bank and Japan's central bank. Those actually have publicly tradable shares that you can buy. So the ownership stake can technically be owned elsewhere, but it usually doesn't mean much.
It all sounds a little bit like, how do I put it? Like an old boys club. Like they all can work together, perhaps collude together, and that doesn't feel like if the commercial banks are shareholders in the Fed, it doesn't feel like it's truly independent.
Well, I guess it depends on independent from whom. It's certainly not independent from the banking system. And when it was made, it was kind of a compromise between the banks and the government. Right? The bank said, well, we're not going to give you all the power. And the federal government says, we're going to take at least some of the power. And that's kind of the arrangement that they came up with. That it partially serves the banks, it partially serves the people, right? Because the people, the one who put Jerome Powell in charge, it's appointed by the president, confirmed by the Senate. We vote for these people, right? So there's basically public representation into the control of the Fed independently, indirectly, and then there's banking input into the control of the Fed. And so basically you have those two directions of power that goes into the Federal Reserve's governance structure. Now, the main benefit that comes from that is that they are independent in a near-term sense, right? So for example, during President Trump's term, he was frustrated with Jerome Powell for increasing interest rates at a time that he felt was inopportune. He would prefer that he did not. He was publicly calling out Jerome for doing that, but it was challenging for him to do anything about it because you had that Powell had his term. He was not doing anything illegal. He's the bank's self-funded. It's not like he can just say, I'm going to fire you if you don't do what I want. And so that's one way that throughout different administrations, throughout time, the president can't just do something right before elections in order to change policy. Now, where it breaks down is if say a government's debt is going to default or something, or if there's some sort of crisis, some sort of war, they can Congress can pass a law and force the central bank to do anything. They can say, look, you have to buy our debt. Or they can do all sorts of stuff like that. So really, it only gives independence in kind of a short term It avoids kind of that unilateral short-term centralization, but you still have that problem of, at the end of the day, when push comes to shove during crisis, there really is no central bank independence.